Welcome to Stock Market Basics, a beginner's guide to investing. If you've ever wondered how people grow their wealth or what it means to buy and sell stocks, you're in the right place. In this video, we'll break down the essentials of the stock market, making it easy for anyone to understand. Whether you're completely new or just looking to brush up on your knowledge, we'll guide you step by step. Let's start by understanding what the stock market is and why it matters to so many people around the world. Ready to dive in? Let's go. Stock market is a place where investors buy and sell shares of companies. Think of it as a giant marketplace, but instead of fruits and vegetables, people are trading pieces of ownership in businesses. When you buy a stock, you're purchasing a small part of that company. The stock market helps companies raise money and gives investors a chance to earn profits. It's a key part of the economy, connecting businesses with people who want to invest. Understanding this basic idea is the first step in your investing journey. Investing in stocks can be a powerful way to grow your money over time. Unlike keeping your savings in a bank, stocks have the potential to offer higher returns, although they come with more risk. By owning shares in companies, you can benefit from their growth and success. Over the long term, the stock market has historically provided solid returns for patient investors. It's important to remember, though, that prices can go up and down, so understanding your goals and risk tolerance is key. Stocks represent ownership in a company. When you buy a stock, you become a shareholder, which means you own a small piece of that business. Companies issue stocks to raise money for growth, research, or new projects. As a shareholder, you may receive dividends, which are payments from the company's profits, or you might benefit if the stock price goes up. Understanding how stocks work is essential before you start investing, as it helps you make informed decisions. There are different types of stocks you can invest in. The two main categories are common stocks and preferred stocks. Common stocks give you voting rights at shareholder meetings and the potential for dividends. Preferred stocks usually don't have voting rights, but they offer fixed dividends and have priority over common stocks if the company goes bankrupt. Knowing the difference helps you choose the right investment for your goals. Stocks are bought and sold on stock exchanges, which are organized markets where trading happens. The most famous exchanges include the New York Stock Exchange, NYSE, and the Nasdaq. These exchanges provide a safe and regulated environment for buyers and sellers to trade shares. Each exchange has its own rules and lists different companies. Understanding where and how stocks are traded is a key part of learning about investing. To buy stocks, you need to open a brokerage account. A broker acts as a middleman between you and the stock market. Today, many people use online brokers, which make it easy to buy and sell shares with just a few clicks. Once your account is set up, you can search for companies, place orders, and start building your investment portfolio. It's important to compare brokers and choose one that fits your needs and budget. Portfolio is simply a collection of your investments. It can include stocks, bonds, mutual funds, and other assets. Building a diversified portfolio means spreading your money across different types of investments to reduce risk. If one investment doesn't do well, others might perform better, helping to balance things out. Managing your portfolio is an ongoing process, and it's important to review and adjust it as your goals or the market change. Every investment comes with some level of risk. In the stock market, prices can go up or down quickly, and there's always a chance you could lose money. However, higher risk often means the potential for higher rewards. Understanding your own risk tolerance, how much risk you're comfortable taking, is crucial. By balancing risk and reward, you can make smarter investment choices that fit your personal goals. Stock prices change based on supply and demand. When more people want to buy a stock than sell it, the price goes up. If more people want to sell, the price drops. Many factors influence this, including company performance, news, the economy, and even investor emotions. Learning what drives prices helps you make better decisions and avoid reacting to short-term market swings. Some companies pay dividends to their shareholders. A dividend is a portion of the company's profits paid out regularly, often every quarter. Not all stocks pay dividends, but those that do can provide a steady stream of income. Dividends are especially attractive to investors looking for regular cash flow, such as retirees. It's important to check a company's dividend history before investing if this is important to you. Stocks are often grouped into two categories: growth and value. Growth stocks are from companies expected to grow faster than average, often reinvesting profits instead of paying dividends. Value stocks are considered undervalued compared to their fundamentals and may pay dividends. Each type has its own risks and rewards, and many investors choose to include both in their portfolios for balance. Market capitalization, or market cap, is the total value of a company's outstanding shares. It's calculated by multiplying the share price by the number of shares. Companies are often classified as large cap, mid cap, or small cap based on their market cap. This helps investors compare companies of different sizes and choose investments that fit their risk and return preferences. You'll often hear the terms bull market and bear market. A bull market is when prices are rising and investors are optimistic. A bear market is when prices are falling and there's widespread pessimism. These cycles are a normal part of investing, and understanding them can help you manage your emotions and make better decisions during market ups and downs. Stock indices like the S&P 500 or Dow Jones track the performance of a group of stocks. They give investors a snapshot of how the overall market or a specific sector is doing. Indices are useful for comparing your investments to the broader market and for investing in index funds, which aim to match the performance of these benchmarks. Mutual funds pool money from many investors to buy a diversified mix of stocks, bonds, or other assets. They're managed by professionals and are a popular choice for beginners because they offer instant diversification and professional management. You can buy shares of mutual funds through brokers or directly from fund companies. They're a great way to start investing without picking individual stocks. ETFs, or exchange-traded funds, are similar to mutual funds but trade on stock exchanges like individual stocks. They offer diversification, low fees, and flexibility. You can buy and sell ETFs throughout the trading day, making them a popular choice for both beginners and experienced investors. Many ETFs track indices, sectors, or themes, giving you plenty of options to match your investment goal. Bonds are another common investment, but they work differently from stocks. When you buy a bond, you're lending money to a company or government in exchange for regular interest payments. Bonds are generally less risky than stocks but offer lower returns. Many investors include both stocks and bonds in their portfolios to balance risk and reward. For investing in any stock, it's important to do your research. Look at the company's financial health, recent performance, and future prospects. Read news articles, study financial statements, and check analyst reports. Understanding what you're investing in helps you make smarter choices and avoid costly mistakes. Take your time and don't rush into any investment. Having clear investment goals is essential. Are you saving for retirement, a house, or your child's education? Your goals will determine your investment strategy, risk tolerance, and time horizon. Write down your goals and review them regularly. This will help you stay focused and make decisions that align with your long-term plans. Investing can be short-term or long-term. Short-term investors try to profit from quick price changes, while long-term investors focus on steady growth over years. Most beginners are better off with a long-term approach as it reduces the impact of market ups and downs. Decide which style fits your goals and stick with it for the best results. Compounding is when your investments earn returns and then those returns start earning more returns. Over time, this can lead to significant growth, especially if you reinvest dividends and stay invested for the long haul. The earlier you start, the more you can benefit from compounding. It's one of the most powerful tools for building wealth in the stock market. Dollar cost averaging is a strategy where you invest a fixed amount of money at regular intervals, regardless of the stock price. This approach helps reduce the impact of market volatility and takes the emotion out of investing. Over time, you buy more shares when prices are low and fewer when prices are high, which can lower your average cost per share. It's easy to let emotions drive your investment decisions, especially when markets are volatile. Fear and greed can lead to buying high and selling low, which hurts your returns. The best investors stick to their plans and avoid reacting to short-term market swings. Staying calm and focused on your goals is key to long-term success. Investing isn't free, there are fees to consider. Brokers may charge commissions and funds have management fees. Even small fees can add up over time and eat into your returns. Always check the fee structure before investing and look for low-cost options when possible. Keeping costs low helps you keep more of your investment gains. Taxes can affect your investment returns. Profits from selling stocks are usually subject to capital gains tax, and dividends may also be taxed. Some accounts like IRAs or 401(k)s offer tax advantages. It's important to understand how taxes work in your country and plan your investments accordingly. Consulting a tax professional can help you make the most of your investment. Over time, some investments in your portfolio may grow faster than others, changing your original balance. Rebalancing means adjusting your holdings to maintain your desired mix of stocks, bonds, and other assets. Regular rebalancing helps manage risk and keeps your portfolio aligned with your goals. It's a good habit to review your portfolio at least once a year. Many beginners make mistakes like chasing hot stocks, ignoring fees, or failing to diversify. It's easy to get caught up in hype or panic during market swings. The best way to avoid mistakes is to have a plan, stick to it, and keep learning. Remember, investing is a marathon, not a sprint. Patience and discipline pay off in the long run. Technology has made investing easier than ever. Investment apps let you buy and sell stocks, track your portfolio, and learn about the market right from your phone. Many apps offer low fees and educational resources, making them great for beginners. Just be sure to choose a reputable app and understand its features before you start investing. Stock market has a long history of ups and downs. Studying past trends can help you understand how markets behave and why patience is important. While history doesn't guarantee future results, it shows that markets tend to recover from downturns and grow over time. Learning from the past can help you stay calm and confident as an investor. Financial advisors can help you create an investment plan, choose the right assets, and manage your portfolio. They offer expertise and can answer your questions about investing. While some advisors charge fees, their guidance can be valuable, especially for beginners. If you're unsure where to start, consider meeting with a professional to get personalized advice. Keeping up with financial news and market trends is important for investors. Read articles, watch videos, and follow reliable sources to stay informed. The more you know, the better decisions you can make. Remember, investing is a lifelong learning process, and staying curious will help you succeed. Patience is one of the most important qualities for successful investors. Markets can be unpredictable in the short term, but over time, they tend to grow. Avoid the temptation to make quick decisions based on fear or excitement. Staying patient and sticking to your plan will help you reach your financial goals. One of the most common reasons people invest is to save for retirement. Starting early and contributing regularly can help you build a comfortable nest egg. Take advantage of retirement accounts like IRAs or 401(k)s, which offer tax benefits and make saving easier. The sooner you start, the more time your money has to grow. Besides retirement, you might invest for other goals like buying a house, funding education, or starting a business. Each goal may require a different strategy and time frame. Define your goals clearly and choose investments that match your needs. Having a plan for each goal helps you stay organized and motivated. Some investors choose to put their money into companies that align with their values, such as those focused on environmental, social, or governance (ESG) issues. Socially responsible investing lets you support causes you care about while still aiming for financial returns. Many funds and ETFs now offer ESG options, making it easier to invest with purpose. Volatility refers to how much stock prices move up and down. High volatility means prices change quickly, while low volatility means they're more stable. Volatility is a normal part of investing, but it can be unsettling. Learning to accept and manage volatility helps you stay calm and stick to your investment plan. Diversification means spreading your investments across different assets, industries, or regions. This reduces the risk that any one investment will hurt your overall portfolio. By diversifying, you can smooth out returns and protect yourself from big losses. It's one of the most important principles for successful investing. Liquidity refers to how easily you can buy or sell an investment without affecting its price. Stocks are generally considered liquid because you can trade them quickly on exchanges. High liquidity makes it easier to enter or exit positions, which is important for managing your investments. Always consider liquidity when choosing where to invest your money. In buying or selling stocks, you can choose different types of orders. A market order buys or sells immediately at the current price, while a limit order sets a specific price you're willing to accept. Understanding the difference helps you control your trades and avoid surprises. Most beginners start with market orders, but limit orders can be useful in volatile markets. Stock quotes show important information like the current price, daily high and low, trading volume, and more. Learning how to read a stock quote helps you understand what's happening in the market and make informed decisions. Most online brokers and financial websites display this information in an easy-to-read format. Unfortunately, scams and fraud exist in the investment world. Be wary of promises of guaranteed returns or pressure to invest quickly. Always use reputable brokers and do your own research. Protecting your money is just as important as growing it, so stay alert and trust your instincts. Regularly reviewing your investments helps you stay on track toward your goals. Check your portfolio's performance, rebalance if needed, and make adjustments as your life or the market changes. Keeping an eye on your progress ensures you're making the most of your investment journey. The world of investing is always changing and there's always more to learn. Take advantage of books, courses, and online resources to deepen your knowledge. The more you learn, the more confident and successful you'll become as an investor. Make learning a lifelong habit and enjoy the journey. Congratulations, you've completed this beginner's guide to the stock market. Remember, investing is a journey that takes time, patience, and ongoing learning. Start small, stay disciplined, and keep your goals in mind. With the basics under your belt, you're ready to take your first steps into the world of investing. Good luck on your investment journey.